I welcome you once again to A.E Accounting Tutorials. Alright, we are going to look at the effect of errors on profits. We all know that errors will definitely have an effect on profits. Okay, but before we look at the effect of profit, let's first of all try to understand what a suspense account is. Because in the correction of errors, we correct the error by the use of the journal proper, by the use of the suspense account, and probably prepare the statement of a corrected net profit. So let's first of all try to understand what a suspense account is. A suspense account is a temporary account that is used to record any differences that may arise due to unknown error. Is that okay? So when an error occurs in our books, it is the suspense account that we use to cater for those differences before sufficient information will be available for them to be posted to their correct account. Is that okay? So let's say that you have your trial balance. Your trial balance this week. This is debit, this is credit. Alright? You have the total. The total you have here to be, let's say $1,000, you have $800. This is the total. This means that the trial balance did not balance, and the credit side is short of an amount of $200, and this might be caused by an error. Is that okay? And we might not know as at this time. So this 200 cedis might be caused by an error, and we need to open the suspense account to cater for this error. Is that okay? So the credit side will be short by an amount of $200. So we open our suspense account this week. Okay, so here we will be short of $200 before it will be up to this. So we open our suspense account. The suspense account. Suspense account. This dollar. Okay, because the credit side of our trial balance are short with an amount of $200, we come to write that maybe a trial balance difference, okay, or difference in the trial balance $200. Do you get it? So that in the process of correcting our errors, those errors that affect the agreement of the trial balance, because they have only one account for the correction to be made, and the other account will go to the suspense account. Let's say if we corrected an error and it end up debiting our sales account, and we are crediting, let's say we are crediting our sales account and we are debiting suspense account, then we come here to debit suspense account in the name of maybe sales, let's say 200. So after correcting your errors, if everything is successful or you are able to do everything well, then the trial balance, the suspense account have to balance in effect automatically. If all errors has been done successful, the account have to balance. Is that okay? So basically, this is the dynamics of the suspense account. But when we take a full practical question and we begin to look at it, you will actually appreciate what I'm talking about. Okay. So let's move to the main topic for the day, which is effects of errors on profits. Let me ask, do errors have an effect on our profits? The answer is yes. Because when errors, we normally commit errors when we are making the double entry, okay? And it is the balances that we ascertain in the double entry that we will use to prepare our trial balance. And it is from the trial balance that we prepare our final account, which is the income statement and that of statement of financial position. I'm talking about the sole trader. Forget about cash flow and company accounts, and let's concentrate on sole traders. They prepare income statement and that of statement of financial position. And if there is an error in the trial balance, it means that because we get an information from the trial balance to prepare our income statement to ascertain our either net profit or loss. So if there is a mistake in the trial balance, it means that the profit that we are going to ascertain in the income statement will be wrong. And because of that, we need to make an adjustment to the profit in order to arrive at the corrected or adjusted net profit. So before we can prepare the statement of adjusted net profit to get our correct or adjusted net profit, we need to first of all identify the effects of the errors on the profit, okay, before we use how the errors affect profit to adjust the net profit that we ascertain from the income statement. So to actually look at the effect, let's first of all talk about some items that are found in the income statement. Okay, if the errors affect items in the statement of financial position, it will never affect the profit, because statement of financial position items are not part of the income statement item, so it won't affect profit. So what we are actually saying is that we are considering items that are being found in the income statement. So if an error affects them, then we see how we adjust them to correct our net profit. So we are considering some items that are being found in the income statement. But in a nutshell, we may say that the income statement is just about comparing an expenses against revenue for a particular year. So we are going to look at the effects on revenue, and the effects of errors on revenue, and effects of errors on expenses, because we compare the two. So let's talk about expenses. So expenses. Okay, so this effect on errors will either overstate the expenses or understate an expenses. So let's consider expenses an overstatement, which is an expenses overcast. So when we overstate our expenses, what will be the effect on our profit? It is going to lower our profit. This is the effect. When you increase your expenses, it means it is going to reduce the revenue and it will lower our profit. So mind you, any errors, or if an error overstates an expenses, or any items that lower our net profit, we add it back to the profit when we are adjusting it in the statement of adjusted net profit. Any error that lowers our profit, we add it back to the profit we ascertain in the income statement to make the corrected net profit. Is that okay? So let's also consider revenue undercast. The reason why I'm talking about overcast and undercast is that all the 12 errors I've talked about, it will either lead to either an overstatement or an understatement. Okay, if you critically analyze it, it will either lead to overstatement or an understatement. So revenue undercast. When you understate your revenue, it will lower your profit. When you overstate your revenue, it will lower your profits. Okay, so what I wanted you to understand is that expenses overcast and revenue undercast will be added back to our profits in the statement of adjusted net profits. Third, expenses undercast. When you understate your expenses, the effect is that it is going to, you will get a more profit than you're supposed to get. When you understate your expenses, you ascertain more profit as you're supposed to get. Okay, let's say 4. Let's talk about revenue. That is revenue overcast. Revenue overcast will still lead to more profit than you're supposed to get. Okay, so when you overstate your revenue, you get more profit you're supposed to get. This 4 item is the summary of the statement of adjusted net profit. There are other items that may fall under this. Okay, so for instance, this expenses overcast. They said that maybe discount allowed overcast. Discount allowed is an expense, so the treatment is the same as expenses overcast. Is that okay? So when they say that maybe purchases overcast, you see in the income statement we have the direct expenses and the indirect expenses. I may say that the purchases is the direct expenses to sell. So the purchases is also an expense. So if they say purchases account overcast, it's the same as expenses overcast. It is going to lower your profit. Is that okay? So let's also talk about the revenue aspect. In the revenue aspect, we may consider maybe sales. Sales is a revenue, and sales account maybe undercast. It will still lower your profit. Okay, let's talk about other revenue. Let's say discount receipt. If they say discount receipt account undercast, it will still lower your profits. Is that okay? So this is basically the dynamics. Maybe a commission received account undercast. It will lower your profits. So with this application, these are the basic 4 items you need to know as far as the preparation of the statement of adjusted net profit is concerned. So with this, let's actually look at the format of the statement of adjusted net profit. Is that okay? So let's look at it. Let's look at it. So we are going to use this dynamics to actually prepare the statement of adjusted net profit. What I'm saying is that these 2 items, because they reduce our profit, we add it back. And because these 2 items makes our profit to be more than expected, we less it. That is all. So let's quickly look at the format of the statement of adjusted net profit. So statement of adjusted, either adjusted or corrected. So adjusted net profit. Let me bring my currency sign. Let's say dollars. Then, because we are adjusting our net profit, we start with the net profit reported from our income statement. So net profit. Now sometimes you may arrive at a net loss. With this net loss we bring it. With this net profit we bring it. So net profit reported. That is reported from the income statement. Then I'll bring it here. Okay, so now we add expenses overcast. Mind you, I told you that this expenses overcast may comprise of so many items. Okay, some may be discount allowed. You need to know what constitutes the expenses. It may be direct, it may be indirect. There's a purchases account. Okay, maybe purchases account. That's, if I talk of purchases account, I'm still under expenses overcast. Is that okay? Maybe rent and rate account overcast. So let's say I'm bringing these items here. I'll sum the 3 up and I'll get this. Okay, and we still talk about we add revenue undercast. We are adding expenses overcast and revenue undercast because it lowers our profit. So we need to add them back. Okay, so then with the revenue, you may have maybe sales. That is sales account undercast. You may have maybe discount received account undercast. You may have maybe a commission maybe commission received account, maybe undercast. You bring the 3 also here. Okay, so you add this, the summation of the expenses overcast to the summation of the revenue undercast, this and this, then you put them here. Once we get, you put them here. So we add it to the net profit, we get an amount over here. Is that okay? After we've added the total of these two, the expenses overcast and the revenue overcast, the expenses overcast and the revenue undercast, we add it to the net profit, then we get this. After that, then now we less the opposite of this. Is that okay? So the opposite of this will be expenses undercast. That is the opposite of expenses overcast. And this all items will fall. So it is up to you to know what consists of expenses. Then you bring it in. There are so many items. I don't want to list them. It's the opposite of this. Then we still less revenue. That is revenue overcast. I told you the reason why I'm using overcast and undercast, all errors may have resulted in this. Then we get this. All errors will either result in overcast or undercast. So the summation of these two, you bring it in. You less it from the total of this amount, you get an amount here. And this amount will be the adjusted net profit or corrected net profit. So basically this is the format of the statement of adjusted net profit or corrected net profit. Okay, so basically these are the effects on profit. In our next video, we'll be taking a full question where we will be asked to solve, correct the error with the help of the journal, the suspense account, and finally prepare the statement of adjusted net profits. If you haven't subscribed to my channel, kindly click on the subscribe button on the screen. Okay, and also like, comment, and share this video for the benefit of others. Until we meet, bye for now.